up 1.2%, is the first quarter employment cost index, and 1.2 equals our third quarter of last year. And to find a higher one, all you have to do is go to the quarter before that when it was up 1.3. High water mark here was 1.4, first quarter of 22. And if we look at the personal income numbers, and hold on, because this is a long list of important information here. If we look at the headline number, it is up 0.3%, up 0.3%. That exactly equals what's in the rearview mirror. And it really, in many ways, calls into question the whole notion of how many are going to get by with inflationary pressures, as we see that the income numbers really have come down a bit. Our recent high water mark has been up 0.9. That was in October. And, of course, when we consider the spending issues, they have definitely moved lower. And I see that much of this data hasn't quite populated yet. So I will continue to monitor interest rates. And just the employment cost index alone has pushed up rates a bit. And we see that the pre-opening equities have drifted. Now, on the spending, we're looking at unchanged on the spending, which equals the last month of last year. We had down 0.2 in November. If we consider real personal spending adjusted for inflationary pressures, that's 0. And here now we get into what I consider the most important numbers. The deflator on a month-over-month basis, high watermark 1% in June of 22, is 0.1%. If we look at year-over-year on the deflator, it's 4.2, a little hotter than expected, well below 5.1, and well below June of 22's high watermark at 7%. Now, if we look at the core deflator on a month-over-month basis, it's up 0.3, exactly as expected. High watermark in June, up 0.63%. And finally, the year-over-year deflator core, up 4.6, same as expectations, same as the rearview mirror, but it just got ramped up a bit on a revision from 4.7, so it is sequentially lower. High water mark there was in February of last year at 5.4%. Now, as we look at the rest of these numbers, granted, they're still way too high, probably because we spend way too much, but we do see interest rates moderating just a bit. And at 3.46, 10-year note yields are down 6 on the day, down 11 on the week. And with that, I will throw it back to the desk.
Okay, Rick, thank you for that. I want to bring in our good friend Steve Leisman into this conversation. He's been crunching some numbers and thinking through some of this, still crunching the numbers, as I can see there on the screen. Steve?
Yeah, Andrew, not good is what I'm going to call this. The 1-2 on the ECI is, I think, the problem right here. We're looking for one. I guess Rick had a slightly different consensus, but the consensus we had from Dow Jones was 1%. It came in at 1.2. It's not decelerating. And what I do want to do is spend a second here and see if any of my charts updated with some of the things that I know that Powell's looking at here. And the issue being, let's see, the year-over-year 4.6. It did tick down from 4.7 or 4.69, whatever you want to call it. And I know that Powell is also looking at it on a 3-month annualized basis. That tick down, that's pretty good on the core number there. So that's pretty good. And then on the 6-month annualized basis, boy, this thing I set up's working pretty good here. So that's pretty good too. You're down at 4.28 on the 6-month annualized rate. So that's a good way to look at it. And then I don't have the core services X energy, but look, it's coming down too slowly. And I'm not sure, Andrew, maybe it's time to have that debate. I don't know how much time you have, but, May, I think, is baked in the cake, 25 basis points. But what I want to look at right now is what's happening to the yeah.
Just one question. I know we all think May is baked in the cake, but what happens if First Republic goes under this weekend? If there's a bank closure, does that change any of the calculus or what they talk about this week?
I don't think so, Becky. I think that First Republic is seen as a First Republic problem. I don't think that they're seeing or feeling this is a broader issue. I think they're going to, my guess would be that First Republic can't go on another week the way it's been going, that something will be resolved today, because then what the regulators have to do is spend a whole nother week trying to get to another weekend, which is when they like to resolve these things. So I would suggest that whatever happens, I continue to hear that there's not going to be a bucket of money from the government, at least something that would happen before a bank was taken over. That's continues to be what my sources are telling me. So I think something's got to pop today. But I did want to look, Becky, just very quickly, what's happening to the outlook for June, and that's still a 70% or a 68% chance of the Fed no change. But we've had this sort of slightly rising idea of another quarter. It's now at 25% for another quarter in June. We went in at 20%. We're going to have to get somewhere. The Fed's going to have to get some cooperation from these numbers like the ECI and the PCE in order for the Fed to feel comfortable that indeed it's on hold. Because there is a question, maybe we talked about this more on Monday, as to whether or not the Fed is tight enough right here. I know you have Jeremy Siegel on. People say the Fed's not looking at everything. I mean, as far as I know, they're looking at everything, and what they see is continued inflation out there.